So why is there so little growth in the economy and in jobs?
Well, the key problem is the debt, which was placed on bank balance sheets and on consumer balance sheets during the last subprime mortgage boom. Although we appear to have saved the banking system from collapse, those debts still are on bank balance sheets, and because banks fear that they may have to write them down, they are reluctant to lend. And consumers who are still holding these very high levels of obligations feel indebted and are unwilling to borrow at normal levels to begin the economic growth. This problem was essentially ignored for fear of causing pain to bank shareholders, management, and bondholders, but still needs to be addressed and brought down if we're to have normal growth. As an alternative, given that we did not do that during the banking reform process, the Fed has taken a second step of easier money policy in the form of quantitative easing, in which they create money with which they buy securities, and those funds then go into the securities markets broadly. This is instead of going through the banking system directly to consumers and businesses to stimulate the real economy. Although this is a weak second choice policy to fixing up the banks, it will have some stimulative effect, but it also runs the risk of creating bubbles again in asset classes, particularly the commodities, which are seeing such strength in the various markets.
So what could have the government done, and what could they still do?
Well, the alternative to what was actually done is what we did with the savings and loan crisis in the late 80s when we created the Resolution Trust Corporation. At that time, the Resolution Trust Corporation assumed ownership of the bad debts in the savings and loans scandal, and they then wrote those debts down and liquidated them and sold them off to appropriate long-term managers in an orderly way. If we were to do this, what we could do is we could buy in the subprime mortgage instruments from the major banks and then break them up and liquidate them to long-term suitable managers of either foreclosed homes, workout mortgages, or solid mortgages, and then increase the ability, in the course of writing them down, increase the abilities of bankers to lend, consumers to borrow, which would then restore normal growth given the monetary policy that we have.